We will now talk about the cap goods in the infra space, also probably touch upon what the FMCG space is likely to do. But capital goods and infra in focus. They have seen some tough times in the past quarters, and analysts do expect the pain to continue in quarter 4 as well. While sales are expected to grow by approximately 10-odd%, give or take a few percentage points here and there, it's the rising raw material costs that are going to play heavy on the bottom line. Let's go across to Megha Chadha from our research team for more on what the street is expecting. Megha.
Well, the continued bleakness in the macroeconomic picture is expected to play out in the quarter 4 numbers as well for the infra as well as the capital goods companies. Do remember, we've already seen a significant slowdown as far as order inflows are concerned. In addition to that, a lot of these capital goods majors as well as road players are grappling with the situation of high debt. That, coupled with the fact that working capital has also been stretched quite a bit, is leading to extremely high interest costs. In addition to that, they've also had some very high input costs that they've been experiencing. The commodity prices have been at a high. So all in all, we're expecting that the top line as far as the execution is concerned is going to be slowing down, and the top line growth is expected to be rather muted. And in addition to that, the high input costs, the high interest costs, in fact, are going to bear rather heavy as far as the bottom line growth is also concerned. In fact, amongst the individual movers, do remember, in the last few days of FY12, we had the road order inflows actually pick up quite a bit. NHAI ended up giving out quite a few significant orders, but all in all, it's not going to get reflected in the quarter 4 numbers. So individually, we've got an L&T where analysts are worried that the company will once again miss the reduced guidance as well. A BHEL also is expected to post a pretty decent set of numbers. They've already been given out as far as the provisional numbers go. And at JP Associates, analysts are expecting a healthy performance for the company. Okay, great. Thanks a lot for that. The expanded capacity of the cement division for JP would probably also aid them. But Manishi, focus on the two top companies. And let's start off with L&T. What do you think the focus would be more? Would it be, if at all L&T does not manage to meet the guidance that it had set out at the start of the year, would the focus be more on that, or would the focus be more on what the company has to say about the next quarter or the next 4 quarters?
I think if the company misses its order booking guidance for the full year of fiscal 12, that could come as a short-term negative surprise to the market, and therefore the stock could correct over the near term. But over the longer term, I think clearly the order booking guidance given for fiscal 13 and the gradual performance in terms of getting new orders, that is going to count, and it's likely to count in a big way. In general, if you look at this sector, there has been 2 or 3 main problems. As your commentator also highlighted, that order flow has slowed down, except possibly for the road sector, and companies are facing much higher capital charges on account of massive leverage that they had taken on their balance sheets and higher input costs. I think that input cost problem is gradually sorting itself out. If we look at most of the other commodity prices, be it steel, non-ferrous metals, or most of the others, there has been a downtrend over the last 3 to 4 months. And I think that would possibly get reflected in the margins of these companies with a 1 or 2 quarter time lag. So as far as this sector is concerned, we think that revenue growth may be in the mid-teens, but there would be a margin pressure for this quarter. Therefore, clearly EBITDA growth would be lower than revenue growth, and earnings growth could be in single digits, even lower than EBITDA growth because of the very high capital charges. So this quarter clearly is going to be nothing to write home about as far as the engineering and construction sector is concerned. But the real juice, the real fuel as far as stock price performance is concerned, is likely to come from the order booking guidance and the actual orders they win over the next few quarters.
Okay. What will you watch out for, Manishi? I mean, one specific idea, from this space, based on what the earnings or the order inflow guidance is likely to be?
Well, there are 2 main stocks that we're looking at. One is, of course, L&T. One can't ignore that, the 800-pound gorilla in this sector. And for that company, naturally, we would watch out for the actual order booking and the margin that it generates for the quarter and for the full year. And, the outlook that it provides about the sector and its own order booking for fiscal 13 and beyond. The other company is IRB Infrastructure. Just watch out for that company because roads is one sub-segment within infrastructure that's doing really well, and IRB is possibly, the best play on that sub-segment. So just watch out for the guidance and the actual order booking performance of IRB infrastructure as well.
Manishi, the other sector that I want to discuss is what we started off this discussion with, something that you believe would be a drag on overall earnings, and that is metals. Steel companies expected to drag, the bottom lines would be dragged even for some of the private companies as well. What happens here? You think the market will take cognizance of the fact that this was expected and therefore is in the price? Or a 15-20% drop in PAT for some of the steel companies could actually prove to be a dampener?
See, the metals, it's a difficult question right now because I think the earnings performance is going to be disappointing. But the problem is that everyone knows that. The market knows that very well. And this is just a continuation of the trend that we are seeing over past 4 quarters or so. So I think in case there's any positive surprise for any of the companies, that could clearly get re-rated because, if you look at the valuations of these stocks, they're trading at possibly 1 times price to book, or in some cases even lower than that. And that's a significant discount compared to their long-term averages, last 5 years averages. So I would think that to a large extent the stock price has actually factored in the worst, and if only we see some negative surprise compared to those rather inferior expectations, one could expect further derating. Now, having said that, even in our model portfolio we're still not overweight the metal sector. There are just a couple of stocks that we have like Hindalco and JSPL, Jindal Steel and Power. But overall, for the bigger ferrous and non-ferrous stocks, they're still absent from our model portfolio because we think that even though the valuations have been beaten down in anticipation of bad numbers, there's still no clear positive catalyst either. So I think investors would be well advised to play the sector very carefully and on a very selective basis. And by and large, we are not really recommending jumping into this sector right now.
Couple of sectors that may show a bit of a positive surprise. Well, in autos, there could be a bit of a negative out there as well, but FMCG clearly would be doing very well. The poll suggests that there could be a over 20% growth in bottom line for the large ones, and some of the smaller consumption themes like a Jubilant may actually do even better. Manishi, what's your sense? The FMCG giants, the large ones, ITC, HUL, maybe even a couple of other smaller ones. You think a 20-22% PAT growth is a given for the quarter?
Yes, I tend to agree with what you said just now, that our earnings expectations, earnings growth expectation rather, is somewhere in the range of 20 to 21% for the frontline FMCG companies. And the other interesting part is that the top line or revenue growth is somewhere in the range of 13 to 15%. Which means that we're expecting some margin expansion in this sector, which is a departure from the trend that we're seeing for most other sectors. So I think on both counts, that is from margins and from the earnings growth perspective, the FMCG sector could do well, and that is one sector that's been providing support to the market earnings growth for past few quarters, and I think in this quarter it will continue to do so.
And Manishi, aside of the commodity price fluctuations or input price fluctuations, typically a margin expansion of such magnitude probably tends to be sticky as well. You think this kind of performance could continue for the next couple of quarters, given that input cost pressures do not vary too significantly?
Well, it depends on which company you're talking about and what is the market position that company has.
What do you like here,
for example, if you take a company like Nestle, for example, which is a clear market leader in the urban food product segment, they've consistently been expanding their margins because the consumer preference or the stickiness of consumer preference for Nestle's products is amazing. It's like it's been proven over the last several years. So a company that has that kind of a market positioning, I think, would continue to do well and enhance margins going forward because it has the requisite pricing power to not just pass on the input cost pressures, but even hike prices beyond that. So, our top preference right now, if one puts the valuation and the earnings growth questions together, is ITC. In fact, as far as the model portfolio is concerned, that is the only stock that we have from the FMCG sector in the model portfolio, because for many of the other FMCG stocks, even though the earnings growth is likely to be resilient, I think the valuations to a large extent factor such resilience in already. But ITC is clearly one stock that we like.
Great. Manishi, lastly, the other rate sensitive, we're not talking in real estate at all, but autos. How do you think the performance could be? I mean, the numbers, the monthly sales numbers that came out in the month of March were a bit divergent, wherein two-wheelers didn't do too well and four-wheelers did well. You think the quarterly earnings could probably show that as well, especially for Tata Motors, wherein JLR is having a superb performance the last 3 months?
All right. So I think in this quarter at least, the four-wheelers may outdo the two-wheelers, which could turn out to be a departure from the past 3 or 4 quarters. Partly because what you said just now, that in a sense the volume growth in the two-wheeler segment seems to have plateaued out. But for the four-wheelers, particularly for Tata Motors, volume growth and particularly external volume growth outside India, that seems to be very strong. So over the near term, I think our preference lies for the four-wheelers, Tata Motors, even Mahindra and Mahindra, even though it has its performance on the tractor sales side has been nothing to write home about, but we think that that's likely to revive in the near term. So we'll do like Mahindra and Mahindra also at these valuations. I think the two-wheeler side are a little more long drawn-out story. So it's like they would possibly enjoy secular volume growth over the next 5 years or even beyond. But in the short term, if you have just a 1 or 2 quarter perspective, then I think the four-wheelers could turn out to be better.